In this video, we are going to talk about why to invest in gold. So before starting, please like this video and subscribe to this channel for our future updates. People invest in gold for a variety of reasons, including meeting financial objectives. However, some people invest in gold for the wrong reasons. As a result, they wind up with an improper investment product, which may jeopardize their financial ambitions. Here are 5 good reasons to include gold in your financial portfolio. 1. Hedge against inflation. When inflation rises, the value of a currency falls. Almost all major currencies have fallen in value relative to gold throughout time. As a result, many choose to save their money in the form of gold. When inflation remains strong, especially in the upper double digits, gold becomes a hedge against inflationary conditions over a longer period of time in the economy. 2. Tangible asset. Gold is one of the few tangible investments, and as such, it gives a sense of security among investors. Buying gold is significantly easier than buying other physical assets like real estate. Furthermore, although digital assets are vulnerable to hacking and other forms of misappropriation, gold is not. It does, however, come with its own set of risks, so keep them in mind. 3. For portfolio diversification. Some economists feel that gold is a highly effective portfolio diversifier because of its low to negative correlation with all other major asset classes. Nonetheless, gold does not have a statistically significant link with conventional asset classes. However, some argue that there is evidence that when stocks are stressed, or when shares decrease fast in value, an inverse link between gold and equities can form. Gold protects one's portfolio against volatility because the macroeconomic and microeconomic factors that drive the returns of most asset classes have little impact on the price of gold. The risk or volatility of a portfolio can be lowered for a given level of returns by adding gold to it. 4. Provides liquidity. In times of necessity, gold investments can be liquidated much faster than other physical assets such as real estate. Except for sovereign gold bonds, gold investments have no lock-in term, unlike many other assets. The redemption amount for real gold, on the other hand, will be determined by the purity of the gold, the denomination, and other considerations such as the market price. In the case of paper gold, the redemption amount is determined by the market price on the redemption day. When money is tight, one can borrow against gold. 5. Geopolitical factors. Gold often performs well during geopolitical turbulence, and the current issue over North Korea's nuclear capacity has increased the yellow metal's chances. According to Prathamesh Malya, chief analyst, non-agri commodities and currencies at Angel Broking, despite the ongoing geopolitical uncertainty, gold prices have remained trading in the $1,300 to $1,360 range in 2018. Even when the emotions have subsided, $1,300 will provide psychological comfort. On the MCX, 31,000 rupees will provide good support in the domestic market. Crises such as wars, which have a negative impact on the prices of most asset classes, have a positive impact on gold prices because demand for gold as a safe haven for parking funds increases. How to invest in physical gold. Physical gold investing can be difficult for individuals who are more accustomed to trading stocks and bonds online. When it comes to physical gold, you'll almost always be dealing with dealers outside of regular brokerages, and you'll almost certainly have to pay for storage and insurance on your investment. Bullion, coins, and jewelry are the 3 basic ways to invest in actual gold. Gold bullion. Most people think of bullion when they think of investing in gold, big, gleaming gold bars locked away in a vault. Gold bullion is available in bars ranging from a few grams to 400 ounces, but 1 and 10-ounce bars are the most prevalent. With the present gold price hovering above $1,800 per ounce, as of December 2022, investing in gold bullion is a costly idea. In addition, unlike stocks, there is no way to obtain a fractional share in a gold bar. Because gold bullion is so expensive, it's necessary to work with a reputable dealer and pay for delivery, with insurance, or storage in a large vault or safe deposit box. If you opt to invest in gold through bullion, it's also a good idea to keep up with gold prices so you can buy at the proper time. Most dealers change their prices depending on current spot prices. Gold coins. Gold coins typically weigh 1 or 2 ounces, but half-ounce and quarter-ounce coins are also available. The most common sort of gold coin is collectible coins, such as South African Krugerrands, Canadian maple leafs, and American gold eagles. Some dealers may sell blanks as well as damaged or worn coins. However, gold coin prices may not be totally in line with their gold content. Collectible coins in high demand frequently trade at a premium. A 1-ounce American Gold Eagle coin, for example, costs little more than $2,000. That's nearly a 5% premium above similar gold bullion. You may be able to get better bargains on gold coins from local collectors or pawnshops, but it's always safer to buy from a trustworthy, licensed dealer. Gold jewelry. You might also acquire gold jewelry that you can wear or that someone else has worn but has been broken. Investing in gold jewelry, on the other hand, has a number of hazards that investing in pure gold does not. To begin, you must exercise caution when purchasing used jewelry because not all second-hand jewelry is sold by reliable merchants. Not only is authenticity important to you, but it is also important to anyone you try to resell the artwork to. As a result, it is critical that you purchase investment jewelry from a trustworthy vendor and receive as much documentation as possible. Second, depending on whatever firm created and manufactured the jewelry, you'll pay a markup. This might range from 20% to more than 3 times the value of the precious metal. You'll also want to be aware of your jewelry's purity, or what percentage gold it is. Gold purity is calculated based on carats, with 24 carats being 100% gold. Lower purity decreases your piece's melt value, or the raw value of your jewelry's components if it were melted into pure gold. Invest in gold ETFs and gold mutual funds. Mutual funds and exchange-traded funds, ETFs, are generally the simplest and safest ways to invest in gold. Each share of these securities reflects a certain amount of gold, and you can easily buy or sell them in your brokerage or retirement account. Investing in gold ETFs and mutual funds can give you exposure to gold's long-term stability while also providing more liquidity and diversification than individual gold stocks. There are several distinct kinds of gold funds. Some are passively managed index funds that use futures or options to track industry trends or the price of bullion. Gold mutual funds like Franklin Templeton's Gold and Precious Metals funds are actively managed professional investors. These funds aim to beat the returns of passively managed index funds. In exchange, they charge relatively high expense ratios. Use future options to invest in gold. Trading futures or options contracts, a type of speculative investment, is the riskiest way to invest in gold. Futures and options are derivatives, which means their value is fully determined by the price of an underlying asset. A futures contract is an agreement to buy or sell a securities at a predetermined price on a specific date, regardless of market conditions. In the meanwhile, an options contract is an agreement that gives you the right to buy or sell a security if it reaches a specified price on or before a certain date. To invest in futures or options, you must first open an account with an online broker that sells these products. Many online brokerages permit trading in these securities, although account holders may be required to sign additional documents acknowledging the risk of investing in these derivatives. You can buy and sell options and futures directly through the platform once you've established a brokerage account. Most platforms charge a commission for all options and futures trades, which varies depending on the quantity of contracts purchased or sold. People who invest in gold through options or futures contracts must keep track of their holdings in order to sell, roll over, or execute their options before they expire worthless. Furthermore, each of these options includes some level of leverage or debt by default, so investors who overuse them and encounter market losses might quickly see their losses rise. Should you invest in gold? If you're worried about inflation and other disasters, gold may be a good place to put your money. Though it can be just as volatile as equities in the short term, gold has retained its value quite well in the long term. You can invest in physical gold, gold stocks, gold ETFs and mutual funds, or speculative futures and options contracts, depending on your risk tolerance. Most consultants recommend that you dedicate no more than 10% of your portfolio to gold, regardless of the form you pick. Investing in any form involves risks. Gold is no exception. However, the idiosyncratic gold market is unforgiving and requires time to learn. As a result, gold ETFs and mutual funds are the most secure option for most investors wishing to add some of gold's stability and luster to their portfolios. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.